All right, welcome back, ladies and gentlemen, investors all around the world, and of course to our valued PhenomGroup.com members. I am your host, Seth Golden. I am joined by the illustrious and, as always, Brad Carter. And we're going to run through some of the trending subject matter around the market, specifically here going into year end. Going to have some questions for you specifically, Brad. And if you have any specifically for me, please feel free to shoot. The first question I want to get into, and before we do some good housekeeping, if you will, here at year end, and while I'm on vacation through the month of December, the first question I have for you is, how's your year going in the markets?
It's been good. Second straight year in a row that was real good. I think last year I finished around 43%. And I'm kicking myself because the only reason it wasn't quite a bit higher is I got into some stupid shorts.
Don't we all? Don't we all?
And I, every time I do that, I go, why would you short anything in a bull market? You don't need to. Just go get the stuff that you know is
Right.
going to win.
Yeah.
So
Making it difficult for ourselves, right?
right. But yeah. And this year I was just looking at that yesterday because I thought you might ask. And my wife laughs when I say I'm kind of disappointed in myself. I said, because I said it could be as low as 25%. And she says, "You're disappointed in that?" And I said, "Yeah, because I should have done better than that this year." But it's going to come, I would say the very low end 25. And I might, if it does what I think it's going to do with the Santa Claus thing and everything, 38-40%, somewhere in there.
Nice. Very nice. Good job, sir. Good job, sir. Well, you know, the market back-to-back years, it's looking, barring something exogenous happening or endogenous, something domestically occurring in fiscal policy or whatnot here into year end, which seems very limited. We're going to have back-to-back years of 20% plus gains. Um, I've been looking at a lot of data, quantitative data, and some qualitative data. Unfortunately, not all data is created equally. And I'm going to example some of that here in this week's State of the Market video. Before we get to all of the details, all of the notes, I do want to kind of walk through. We have a lot of new Phenom Group members, which we are grateful for, and we hope that you take this journey into 2025 with us. You stay dedicated, you stay disciplined and devoted, to the process of investing. And for our newer members, kind of just want to give you an overview of the website really quickly if you're having a difficult time navigating things. Primarily, the only thing you should be looking for on our website are the research reports. Now, the most recent research reports, all you have to do is scroll down, recent research reports. See how simple I make it? I try to do the same thing with my portfolio. Keep it simple. But our most recent one is right here. It's the largest on the homepage. All you do is click on it, takes you right to the report. And then after that, in descending or cascading order of date, going back to November 17th. Now, the reason why I want to go over this as well into year end and for our newer PhenomGroup.com members is do not subscribe to PhenomGroup.com without making sure you read our year end 2024 2025 Outlook report right here titled Keeping It 100% in 2025. So please make sure you dedicate some time. It is a very long report. It's filled with graphics, facts, analysis, analytics, data, you name it. I throw in some opinions because I tend to have a decent opinion about how things are going to play out going forward. But all of our Phenom Group members should be familiar with our year-end 2024 look into 2025 report. If you ever have any questions, Please feel free to send me a direct message at your leisure. Just go to your profile page. And you should do this anyways, maybe once a month or so to see if you have any messages from myself, from the staff, so on and so forth. But if you do have any questions or feedback or anything you want me to take a look at, just send me a direct message at your leisure. I'm usually able to get back to folks within 24 hours. And of course, the homepage takes you back to the homepage. Again, also for our premium members, if you're looking for, make sure if you are a premium member that you do have access to our private X. I know it's not Twitter anymore, but our private X feed, which is where we deliver our trade alerts and just post our weekly content, our weekly publications as well. So just hit the follow button. Again, this is for our premium members only. Our contributor members, look, if you've been with Finom Group a while, you love the research, you like the way we view markets, you've even seen some of our investment ideas and or trading strategies within our weekly research reports, consider upgrading to the premium before next week our prices go up. Every year we raise our prices. For the contributor membership, it goes from $18.99 up to $24.99, and our premium membership goes from I believe it's $69.99 right now up to $79.99. So, and if you are a contributor member and you just kind of want to check out premium, maybe just for a month to see if it's for you, if all the additional features like Telegram, we use Telegram for our premium members as well. So you can, we've got the chat for premium members during the course of the day, sharing ideas, links, so on and so forth. We have Traders Corner, where our members who are comfortable doing so share their actual executions throughout the course of the day. And just like Twitter, but we like Telegram better. I'm sorry, X, we like Telegram better. This is where we issue our official trade alerts as well. The difference between X and Telegram being that you get a more real-time alert with Telegram than you do on Twitter, because Twitter did away with SMS messaging in 2021, so you no longer get that real-time alert. You actually have to go to Twitter to see if something was posted. Telegram, we've got a number of different quote-unquote channels in Telegram to suit your fancy. So these are all the features for our premium members. And again, if you are a contributor member and you're thinking about upgrading, might be a good idea to do so before rates go higher. With that being said, all right, housekeeping is out of the way. Let's talk about where we are here at year end. And as the title assumes, not all quants are created equally. Not all quantitative data is qualitative data. And you'll hear more about that as we progress. This chart right here in front of us from the Lighthole Group is pretty interesting, because what's happening this year, Brad, is not only is the PE, right, the price to earnings, the price to earnings ratio growing by double digits, but earnings are growing by double digits this year as well. The only two other occurrences, as you see here in the box, 1997 and 2003. So this is the third occurrence, which is right next to the 2003 one, the little bubble there. So this is just the third occurrence that is happening. I mean, it's extremely rare what's going on this year, and I don't think a lot of folks appreciate it. And we hear all of the market's going to crash. You can't be up 20% back-to-back years and expect good things to happen next year. And maybe that'll be the case. Who knows? But if only using this kind of data, did the market go down in 1997? No, we had a positive year. Did the market go down in 2004? after the 2003 occurrence? No, 2004 was positive as well. So, people concerned about high valuations and high earnings growth here in 2024 does not necessarily mean anything is going to happen good or bad in 2025. Now, valuations are not a timing tool, as most people have heard that colloquialism. Secondly, they're more of a sentimental read on things, right? I mean, we might finish this year at close to a 23 times forward S&P 500 PE ratio, which would be the highest closing PE value since, of course, the dot-com period. So very rare air that we find ourselves in. Now, unfortunately, speaking of quantitative data, we had the opportunity in October, up to the last trading day of October to have a 6-month win streak. And that would have been great. Why? Because the next month gain after 6-month win streaks, which are rare, right? It's only happened 1, 2, 3, 4, 5, 6, 7 times since the 1970s. The next month's gain, i.e. November, very, very strong. Unfortunately, with the Halloween massacre, it was Friday the 13th this past Halloween. I think the market fell 1.8% that day, the S&P 500, to finish the month in the red. Did it matter? Not really, because we all know that November was a very, very strong rebound month. But in the future, when we get a 6-month win streak, you might want to keep this data handy, folks, right? The positivity rate for the next month, the next 30 days is 100%. All right, now here's another quant. I kind of want to keep certain quantitative data front of mind as we go through year end. And some of this is within our year-end 2024, 2025 outlook report. For all prior years where the index hit 800, this is kind of a baseball analogy. When the index hit 800 through October, the forward 2-month returns, a 14-1 track record. 14 times up, only 1 time down. What does it mean to hit 800? Well, that essentially means in the past 10 months, 8 of those months were positive, 8 out of 10, or batting 100, so to speak. And here are all the occurrences from Steve Depp as he looked at this quantitative data set all the way back to October of 1950. And again, only 1 loss. The one thing that he got wrong with this study, to correct this post from Steve Depp, the lone loss was actually in 1972, not 1964, which he had stated. It was the lone loss. I'm sorry, it was in 1964. He says it was in 1972. It wasn't. It was in 1964. I looked back at the data, and the final 2 months were positive. In 1972, but they were negative in 1974. The point being here is there were high odds at the end of October. There were very high odds, a high probability that from November 1st, or the first trading day of November, through the end of the year, December 31st, the market would have been positive. We are significantly higher than the closing date on October 31st. So far, this study is panning out quite nicely. Using other data, just starting from October 15th through the end of the year, I mean, most people understand that, when you start the month of November, you're in the best 6 months period to own stocks. So a lot of the data that we look at this specific time of the year, October, November, December, the fourth quarter, it's generally going to be positive. The median S&P 500 return from October 15th to December 31st in an election year, which is this year, is 7%. Now, the closing value on the 15th of October was 58.60. If we project out a 7.04% return through December 31st, that would take us to 62.70. There's no guarantee you're going to get the median S&P 500 return, but it just gives you a good understanding of the possibilities, or probabilities, as I like to say. Now, here's another study, again, just keeping some of the quantitative data front of mind since October and as we progress through the end of this year into the first quarter of the new year. When the S&P 500 ends the month of October with trailing 6-month returns of 10% or more, which we've satisfied, that's why the date is there, it's part of the study. October 2024 satisfies this criteria. The remaining 2 months of the year have never closed lower. Again, this criterion is that the market has been up 10% or greater. We look out 2 months. Here's the column, 100% positivity rate, again going back to October of 1950. So while this specific criteria here was just about an 800 batting average, this is using a different criteria, but tells a very similar outlook, an even better outlook. Why use the 10% year to date? Why use that criterion? Mainly because all of the data that you look at in the way of quantitatively studying the data, it's about fund flows. And fund flows tend to be very, very consistent. So when we're looking at quantitative studies like this, it's telling you the story of fund flows throughout history. And fund flows are very consistent, repetitive. And so far, once again, those fund flows are telling a story that right now looks like this is going to stay perfect. What's also interesting is if we go further out in time, 3 months, which would take us to January, the percent positivity rate is still in the 90 percentile. 4 months later, 90, 90, 90, 90. I mean, you got to go out 8 months from the end of October before you even drop down into the 80 percentile probability rates. This gives us a lot of information on what we might anticipate for 2025. The lone wolf that kind of, detracts from the perfectness in this study, in this quantitative data, was, of course, after 2021. And this also gives us some additional information. When we ask ourselves, well, why, right? And this is why it pays to be an active portfolio manager, keeping your touch points with the market, continuously, staying apprised of what's happening and why it's happening. So if we ask the question, Brad, why did this detract from the perfectness in this study? In 2022, what happened?
Well, you've got events that happened, and those exogenous events we can never predict.
Right. Ukraine, Russia,
yeah, exactly.
Spike in inflation, and it pulled the Fed into the picture.
Right.
Yeah. So but that also tells us something about fund flows as well. It takes an exogenous or endogenous event to detract from such perfect quantitative studies. And that's usually the case with anything. The markets are going to trend higher over time, and they're generally only disrupted by exogeny or endogeny. So.
Yeah.
So, I wanted to touch on this, Brad, for a moment. In our, final report of the year with our 2025 outlook, I dedicated a section of the report to trading and investing strategies. And maybe somebody's a novice, new to the investing and trading world, maybe even intermediate, but struggling to find consistency and improving performance with their whole investing and trading process. This section can prove an eye opener. Now, this is factual data from FINRA itself, which is offers data sets on all trading platforms. It compiles them into a singular data set to understand what works and what doesn't work, or what has been working and what hasn't been working. And the reality is that day trading, especially by oneself, a lone wolf trader, your success rate is 1%. The day trading failure rate is 99%. If you hold the opinion you're going to be the day trading unicorn of the world, I've got a bridge you might be interested in also. Now, 80% of new traders fail within the first year. 80%. So if you start on January 1st, it's your first year, you've decided you want to trade, you open your brokerage account and you want to trade by yourself. 80% of those individuals, that population of the investing and trading community, will fail within the first year. 99% will fail within their first 2 years. And please don't find yourself of the opinion that such trading failure rates are assigned solely to novice and or retail traders. That couldn't be further from the truth, as most professional fund managers underperform their benchmark index over the entirety of their career. And this is an example of that. This is from Apollo Group and Torsten Slok. Roughly 90% of active equity fund managers underperform their index, and 81% of active fixed income. It's one thing if you're underperforming as an equity manager. If you can't at least market perform as a fixed income fund manager, please don't believe that lone wolf trading is where you're going to find success. Okay? That's probably furthest from the truth. Now, at Finom Group, we like to practice, and we make it part of our regiment to grow our knowledge of the three key and or main investing disciplines: fundamental analysis, or a certain degree of macro fundamental analysis, technical analysis, and quantitative analysis. The most immature discipline to date is quantitative analysis. Quantitative analysis really only came on the scene just prior to the great financial crisis. And then it quickly got wiped away, because a lot of quantitative analysis is about identifying the probabilities in price action in the future, whether it's a month, 3 months, 6 months, 9 months, 12 months, 2 years from now. That's what quantitative analysis is trying to outline to the individual users. But then came the great financial crisis, and a lot of detractors from the discipline said, oh, well, how come you couldn't predict that? Where were your probabilities for that? But this is why it always comes back to, in order for things to go awry or to detract from the outlined probabilities, you need exogeny or an endogeny. It's not just going to happen because you don't believe in quantitative analysis. You don't believe in the repetitiveness of fund flows. Now, a lot of investors, a lot of people, publicly have heard me say this before as well. I came up as a CFA. I was a sell-side analyst covering consumer packaged goods, retail, and IT hardware. Those were my three categories of focus as a sell-side analyst from basically 2002 to 2016, 17. I've never was terribly fond of technical analysis. However, I realized over the years that I simply had to dedicate myself more to the exercise of technical analysis and in order to get a better appreciation of it, if not to better utilize it to improve my overall results in some way, shape, or form. What I have come to find factually and anecdotally is if I'm ranking the order for which I'm going to use the three investing and trading disciplines, I'm moving technical analysis to the bottom and elevating macro fundamental and quantitative analysis exercises. A lot of the data that we've disseminated at Finom Group over the years has factually evidenced the reasons why this is probably an appropriate way of prioritizing the three disciplines. Trend following strategies are market underperforming strategies, and they are almost all technical strategies. This is not to say that somebody shouldn't use technical analysis or that they can't profit by using technical analysis. It's just a matter of the data doesn't lie to us. As we see in this chart, buy and hold beats chart-based trading models, hands down, and almost always. The only time that buy and hold does not beat chart or technical-based trading models is during down market years. It's the only time. Why? Because most technical and or trend following strategies, they are about in and outs. They're not about buy and hold. So you can avoid a lot of the downside in these chart or technical based trend following strategies. The problem is in up markets. Because again, the nature of these technical trend following strategies is in and out. Now, that doesn't mean in and out on the day. It could be on the week. It could be on the month. It could be on the quarter. But you are always going to miss some of the upside if you're simply not buying and holding and capturing every single uptick with those individual stocks and or ETFs. So, how do you feel about what I just said there, Brad, when it comes to the three disciplines?
Well, as you know, I agree with your overall philosophy. For newcomers here, Seth and I have been together since somewhere around 2011, 2012. So
you might as well be married.
Yeah. In fact, you weren't married, I don't think, when we first
Correct.
started working.
Correct. Yeah.
And now you got two kids. So
yeah.
And I think what I want to interject is I think sometimes a newcomer might misunderstand by what we mean by buy and hold. That doesn't mean you don't manage your portfolio, you don't manage that stock, you don't trade around a core and that kind of thing. It just means you stay with that company because you've got good reason for staying with it.
Right. Right.
So you buy your 25 shares of Amazon, and it goes down a little bit, and you buy a few more shares, and it goes down a little bit, and you buy a few more shares. Then you say, okay, that's about all I want to have in that particular stock, and then it goes way up on you over a couple of days or something on it, so you skim a little off.
Yep.
That's still buy and hold. That's
right. You're keeping a core amount of shares, but using the dips as trading opportunities.
Right.
Yeah, absolutely. Yeah, I mean that's generally. So what we've done at Finom Group is basically incorporate the Golden Capital Portfolio strategy, which is outlined here. And again, the transcript for this video, for this state of the market video, is available on site for PhinomGroup.com contributor and premium members. We outlined the 1% for 1% strategy in our year-end and year ahead outlook report a few weeks ago. And I've extrapolated that and posted it once again here in this weekly video. And basically the 1% for 1% strategy is nothing more then a bolt on to the buy and hold, and is exactly what you just articulated there, Brad. So if I own Amazon, let's say I bought it at $100 and it drops down to 90. I want to buy some more because I believe in the fundamentals of the company. And maybe it even drops down to 80. I want to buy some more. So when it starts to rise again back to, and a couple percent here, a couple percent there, I might trim a little off the top there, which only serves to lower my core cost average. So the core holding, if I'm making a profits on these trades around the core holding, it serves to lower the cost average of that core holding. So am I buying and holding Amazon? Absolutely. But if I see an opportunity to take advantage of cheaper prices and the fundamentals are still the same, I'm going to
Right.
take advantage of it. I'll take the hit on the short-term capital gains tax if it serves my core holding cost average that much more. So it's a vertical, if you will, or a bolt on to your buy and hold stock. I mean, I remember we started buying PayPal. I think it was in 2022. It dropped all the way down to $100 a share. I think that was our first trade
Yeah.
on PayPal. And so in that year, we traded. I counted up all the trades, which we do log here in our spreadsheet. I'm not sure if I've updated it this week. Yeah, I didn't. I got to update from 11/25 forward. But we keep track of every trade alert, and we have since 2020. By the way, I literally have another MacBook with all of our trade alerts, in spreadsheets since 2018. But that MacBook crapped out on me, so this one starts in 2021, I believe. Yeah, there's 2022. But you see all the PayPals, $91, $86, these are all profitable 1% trades after that first $100 entry. And so if you do that 63 times, remember, you started at $100, you get a 1% or greater profit for each scalp trade around that core holding. It drops that core holding 1 percentage point each trade. So while the stock was for crap, literally for 2 years, last year, even into the most of this year, dropping into the 50s, we were fine because 63 percentage points from $100, you're in the high 30s, low 40s. You can sit still and wait for the fundamentals to turn around, or you can also make a decision. Do I really want to hold this and trade it? I mean, it's 2 years. Fundamentals haven't turned around to where investors are excited about this, and I still have a profit. So that's the 1% for 1% strategy, which is again just a vertical or a bolt on to the buy and hold strategy. And all that's outlined here in details how it works. The strategy is kind of, if you can think about the golden capital portfolio strategy, with this graphic is a perfect example. Saving $8 per day. It seems like nothing, right? It's just so small. It seems like nothing. But if you do that over the course of a whole year, you've saved $2,920 per year. If I read 20 pages per day, again, it doesn't seem like much, but that's the equivalent of 30 books per year. If I'm walking 10,000 steps per day, again, it doesn't seem like much. It's the equivalent of running 70 marathons per year. We do on average 300 official trade alerts profitably a year. 1% a time, 1% at a time. It doesn't seem like a lot. $10 here, $100 here, $50 there. You do that 300 times a year, you got a home run. Base hit after base hit after base hit after base hit, you've got a home run. And this is essentially what that looks like. 1% better every single day, trade alert wise in your portfolio, you've got a really nice home run. Take it slow, folks, right? Little things add up to big things. I want to end this segment of our state of the market video. This was ridiculous when I first saw it. It's even more ridiculous today. This person, again, be careful with social media, folks. I think this, every video, I do this kind of public service announcement. There's folks out there that are okay harming your portfolio, harming your emotional quotient with these fanciful charts and ideas or notions about what they think is going to happen to the market in the future, especially doing it via some kind of a chart like this, a technical configuration, if you will. Why I believe the S&P will top by October 31. I traded both the dot-com boom and the great financial crisis. I see few parallels of today's S&P with 1999 to 2000 mania. What I do see now is an eerie similarity to the Q3 of 2007. I'll begin with the 6-9 SPY chart. And what he's showing here is the market top there in 2007 and the subsequent great financial crisis bear market. Now, I was pretty honest and frank in my response to this on X. I said all these things right here. No, you did not trade 1999 to 2000 mania, nor the great financial crisis. No, you do not see an eerie similarity to Q3 of 2007. Yes, it is unfortunate that you've decided to fib. Anybody who traded then would know to look for confirmation via the AD lines, which was not present in 2007. Now, here is the chart from 2006. Here we are, 2007. Let's fast forward to Q3. Here you are, the S&P 500 topping out right there in October of 2007. My top chart is the advanced decline line for the New York Stock Exchange. It topped out back here in June. Now, if the S&P 500 or the NYSE itself is making higher highs or all-time highs, you want to look for confirmation in the advanced decline line. There was no confirmation of this new high. This told you, be careful. The market overall does not believe in this new high, and it has not for quite some time, several months, in fact. Anybody who was actually trading back then knew that. So when somebody says that they traded, they're fibbing. And that's how I knew this person was fibbing and just putting something out there to get attention. That's what a lot of people do in social media. Hence, please be careful who you follow, what you gravitate towards, so on and so forth. Now, speaking of Warren Buffett, which obviously is a segue here, because we haven't mentioned Warren Buffett. Before we get into my thoughts on Warren Buffett, based on the facts, I always look at the facts. Now, Brad, you recall when he got into Occidental Petroleum, 2 years ago?
Oh, yeah, because I was already in that stock, and I was thanking my lucky stars that he decided to do that, because I was in a big hole with Oxy at that time.
And it initially rose on his filing.
Yeah.
So what are your thoughts on that fast forward today? And I'm not even sure. I haven't looked at the chart in a couple months. Let's see.
He got involved with them when they made that purchase of what was the company? I can't remember. It's neither here nor there, but that's when
it's at a multi-year low. Yeah.
Yeah, and that's what caused the stock to plummet, because they put everything into that deal and had to have Buffett's help to even make the
Gotcha.
deal work. Yeah, and he got some stock options out of the deal and all that stuff. It was a really good thing for him. And you'll remember when oil plummeted as a result of COVID,
Yeah.
he started buying on his own more oxy all the time, and every time it dip, he'd buy the dip and he'd go with it, and I was already in the stock and comfortable with it. So when oil dropped to zero and actually below zero briefly, uh, I just kept buying little bits of shares there. And but
This was my line in the sand so far as disseminating, in our live trading room that we have during the course of the week when I'm not on vacation, of course. We have Monday through Friday, we have live trading room activity where we discuss everything that's going on in the markets throughout the course of the day. And I've been saying for a long time, if it breaks through this 2-year support, look out below, right? Yeah,
right,
at the $56 level there, and certainly it did, here, and it just cascaded, right? We call it the rule of three for a reason, and it's not perfect, but it definitely has a goodly amount of efficacy. It knocked on the floor once, twice, three times. That next time it usually will cascade lower, and that is exactly what happened. The rule of three played out in a pretty nasty manner. This is again an example of Warren Buffett himself breaking his rules. He did so with the airlines just after COVID. He did so with autos in the past. And he did so when he bought IBM, right? He's not a tech guy, but he decided to buy IBM. And that didn't go, I don't think he lost really much, if anything, but it definitely wasn't a Buffett outperforming stock. But when he got into Oxy, I said to myself, why is he doing this again? He's been breaking his own rules far too many times over the last several years or in the post COVID period. And so, I know, look, he's a great investor. Don't get me wrong. I'm not detracting from his historic, performance going back 60 years. But what I am suggesting is that when high profile investors are doing what they're doing with this stock or this index or this fixed income investment vehicle, you don't know what their time horizons are, you don't know what their motivations are, and you don't know that they necessarily will match yours. You have to do what is going to help you achieve your goals and objectives when you are investing. And I've long since said Warren Buffett is a great investor, but that doesn't mean that he's an outperformer. Not with his public 10F filings with what he owns. More often than not, he's underperformed. And that's what this data has articulated and what we've disseminated to Finom group members in the past. I wholly respect Warren Buffett. Nothing beats the GOAT, though. If you're getting beat, like Michael Jordan, nobody beat him, right? Six times in the NBA Finals, 6 world championship rings. Nobody beats him. He's the GOAT. Well, when it comes to the market, there's plenty that beats Warren Buffett picks and the general Berkshire portfolio. The NASDAQ has beaten Warren Buffett or the Berkshire portfolio. And this is over a 5-year period. Berkshire, 100%. Look at the technology sector ETF, up 167%. The Qs, the NASDAQ 100 ETF, up 143%. Fast forward over 20 years. Buffett did great, up 700% in the Berkshire stock. Technology, up 1,000%. NASDAQ 100, up almost 1,200%. Is Warren Buffett good? Yes, he's very good. He's not the NASDAQ, and he certainly isn't the technology ETF.
right.
So it's all about perspective. How we put these people on pedestals or whatnot. We really need to put things into perspective. He's not beating the market. In fact, since 1995, he's underperformed the market.
Right. Yeah, he has.
So And this is just another way of viewing the same data here. This is Berkshire Hathaway relative to the technology ETF on a trailing 1 year relative return since 2010. And what we can see is when we have the squigglies, the two trend lines below the x-axis here, that's when XLK and QQQ are outperforming the Warren Buffett portfolio or Berkshire. When the lines are above, Berkshire's outperforming, and what we can see is more often than not, the trend lines are below the 0% line, meaning that XLK and Qs are outperforming the Berkshire Hathaway portfolio. So a lot of details on this if you want to go into it. But, this is just another example of, back in March, I tweeted this in March, when the AI theme really gripped the markets and investors. We knew about it in 2023. We knew things were trending when it came to AI, but it was back in the first quarter of this calendar year, there's my tweet from March, where I started to realize this was just another platform of technology. And in order for it to seek and achieve mass adoption, it needs an operating system to rest on. Well, the largest user base when it comes to, dominantly secured mobile computing is the iOS platform by Apple. So I was of the opinion that all roads, when it came to AI features, functions, applications, they were eventually going to land on the iPhone. And so I had put out this tweet. Now, we all know that Buffett, for the last 6 months or 2 quarters, he's been selling. He's been a seller of his Apple stake. Has he done great with Apple? Yes. He bought it for the first time in 2016. You talk about a home run, there's your home run. I mean, he's done very well. So selling, again, what's his objective? What's his motivation? I mean, he's got thousands of percent already gained in his Apple ownership. He's fine. But when he sold, when we first learned of him selling Apple shares, the media made it out to be this tell that Apple was behind the curve on AI, that Apple wasn't an innovator, the stock was a sell, it's probably going to get booted out of the Magnificent Seven. I mean, that's all we heard from the financial media, which made no sense to me. But that's what they're in the business of, right? Megaphoning, entertaining us with their headlines. This Barron's article, it basically calculated Berkshire move to sell Apple doesn't look good. It may have left $25 billion on the table based on his selling price of around $185. And when this article came out, it was around $210, $215. And of course, now we know where the stock is. Now, in one of our reports back in June, I had written, right, this is all from our reports back then, that, we had the WWDC, the Worldwide Developer Conference that Apple has every year. It was on June 10th. We live streamed it in the trading room that day. And in watching it and listening to it, I said, this should do it. This should probably do it. Finally, we should have a good upgrade cycle and see some solid iPhone growth in the out quarters. So while the stock was dropping, right, I think it was 197, I started buying shares. 194, it kept falling. I bought some more, 193. I bought some more, 192. I liked what they were saying. I liked what they were showing. I liked their directional articulations when it came to artificial intelligence, Apple intelligence, as they called it. So I bought the shares based on my fundamental beliefs not just with what they were articulating at the WWDC event, whoops, but also my belief that all roads lead to the iOS platform. When it comes to AI adoption, you got to land there. And so I kept buying. While Warren Buffett was selling to me, I kept buying. And now, of course, the stock price is at all-time highs. And so what am I doing? My cost average is in the 180s again after trade. See, I'm not just buying and sitting pretty, waiting, but I've done several trades around these prices to lower it into the 180s, my core cost average. Well, from the 180s all the way up to the 240s, now I'm able to make decisions. I mean, it's exceeded my profit objective in a very short duration of time. I can trim some. I can see how things play out in the subsequent quarters. I can see if the fundamentals are delivering on my forecast when it comes to iPhone adoption rates and just the general sales trends in iPhones. Any thoughts on AI and Apple, and you doing anything there, Brad?
Well, I followed your comments about Apple and AI for a long time and totally agree with them. I mean, the idea that Apple needs to be an innovator in AI sounds silly to me. They're the platform.
Yeah.
and,
Yeah.
and so for people to get, it's just, I don't even watch MSNBC anymore. I don't even turn to that channel because they stay, when something happens like Berkshire, they sell their Apple stock or they sell part of it. Well, something must be wrong with Apple. So they invent something that could be a story.
They do. I love how you said that word because they do. It's like they invent these reasons, these rationales that sound smart. They sound smart, but they're practically stupid.
Right. So to me, it was just the perfect opportunity. I did exactly what you did. I thought, okay, this is going to cause it to sell off. Well, that's great because we can start buying it now, and it's worked out.
Yeah.
The very fact that we have AI being the big deal right now is a reason you should own stocks like Apple.
I agree.
No, it's not the only one. But,
and when it comes to risk management, this is something this is the other consideration, right? Let's say I'm wrong on the upgrade cycle, a more positive trend in iPhone sales going forward. Let's say I'm wrong, and maybe they just status quo, very low growth, but growth nonetheless. What am I still buying here at the end of the day? I'm buying one of the best companies in the world with one of the best management teams in the world and one, if not the best balance sheet in the world. That's my risk management.
Mm-hmm.
Again, it's about what you're buying at the end of the day.
So, yeah, what Apple needs to innovate is that phone. Keep it moving forward.
What goes in there, yeah.
Yeah, make it more receptive to the new AI technology that's coming out, increase speeds and all these kinds of things, which they do.
Right. So, yeah. Right. It sounds, everybody wants these pie in the sky, incremental technological feats of strength. But in reality, Apple doesn't need those kinds of, incremental feats of strength. They just need to slowly but surely, as you're saying, increase speeds, battery life, duration, and the same, security features that have always been, best in class. That's all they need to do. Let other people spend the money, on CapEx and R&D, building new technologies or building new applications. Let them spend the money doing that. We have the platform that they have to come to at the end of the day. So, yeah, totally agree. All right, our last segment here, I believe, using the right quant. So we've talked about some quantitative data. And here is where we're going to kind of distinguish between what is quality and what is lacking quality or should, again, be deprioritized when it comes to some of these quantitative studies. The first one that you see here is one from Carson Research and Ryan Dietrich, and as the title of the quant says, S&P 500 returns in December when the market is up 20% year to date. Now, these only go back to 1985. So up 20% year to date. The December return, almost always positive, except for right there in 1996. So you got a 90% positivity rate. By itself, if we knew nothing else, we would want to lean into this. So at the end of how do you use this data? What is the end of November S&P 500 price? Any price below that within the month of December is a buying opportunity. Why? Because you have a 90% probability of finishing December above the November value. So that's how we use it. Now, I did want to see what went wrong in 1996. So is this? Yeah, here's the 1996. What I looked at was the advanced decline line. Because again, even if you bought in 1996 and you had a negative return using this data, the advanced decline line finished at an all-time high at the end of that year. Finished at an all-time high, telling you that, this may have just been some consolidation. If you bought just based on this data alone, you probably would have been fine just holding on a little bit longer because the advanced decline line is telling you there's more highs ahead, folks. Historically, there's going to be more highs. And surely enough, we all know what happened in 1997. You had a double-digit S&P 500 return. So I just kind of wanted to look at what went wrong. And it's a good exercise. You should, right? Whenever you see a detractor from the overall performance results, go to the charts, see what went wrong, and see what maybe did go right, like the advanced decline line, to give you a better idea of how to behave. All right. Now, here's the problem I have with this study, as I explained down here. The main issue Finom Group has with the aforementioned quant data from Ryan Dietrich is that it is an example of right-fitting data to serve some kind of purpose. Now, I don't know what the purpose is. I do, because you should always be bullish. We don't propose to know what the purpose might be, but here is the reality that we should recognize when it comes to the quantitative analysis. The data has to fit the crime. Or better stated, the data must fit what actually just happened. Did the market finish up 20% year to date? Yes and no. Going into December? Yes and no. The reality is it finished up greater than 25%. Again, we're getting to the very end of the year, folks. There's not a lot of time on the clock when it comes to upside or downside for that matter. So we really should get very finite and make sure we're using data that fits the crime. What actually happened? This looks at years when the S&P 500 gained greater than 25% through November, because we gained 26.5%. So anything greater than 25%, these are all the years going back to 1927. The first thing you do, throw out everything before 1957. Why? The S&P 500 wasn't the S&P 500 until 1957. So if we cull it down some more, there's only 1, 2, 3, 4, 5, 6, 7, 8 occurrences, 7 previous occurrences. And 2 of those delivered negative returns. Again, this helps you to better recognize what the probabilities really are. Now, usually you do have a positive return in the month of December. But we want to make sure, as a discipline, we're using the data that represents exactly what just happened or as close to what happened, in the actual price action. Either way, both of them skew positively for the month of December. And indeed, we are up already greater than 1% in the month of December. All right, with that said, here's another one. Technology strength faded briefly post-election in 2016. What we're looking at here is Trump 1.0, right? That was his previous term, versus the probabilities for Trump 2.0. And so the technology sector, information technology sector, this is what happened the first go around. In 2016 is the blue line. Initially, after election day, technology was weak. But in December, technology took off and it just kept going. And it was leadership throughout President Donald Trump's first term. So far, that's how it's working. In December, we have tech and NASDAQ leadership once again. Again, this is just one example, and we are right fitting for Trump, basically, how the market performed, or at least how technology performed over Trump. So I'm not very fond of this kind of quantitative data or quantitative trend, but it, just to kind of round out all of the stuff we are looking at, that's an example. Now, the data comes from Ned Davis Research, Rob Anderson. And when he saw that I had tweeted or posted it on X, he says, a big difference to keep in mind between now and the first President Donald Trump presidential term was that tech was about 16% of the S&P 500 back then. It's about 31% of the S&P 500 today. Does that mean we should be worried because it's so, the index itself is so concentrated and technology is the biggest part of the S&P 500 relative to back in 2016, 2017? I would say no. If you are worried that the technology sector is so big and has grown so much, you could have said that coming into 2024. Because it ended 2023 with a market cap weighting of about 28%. Again, that's the second highest cap weighting in its history coming into this year, and the cap weighting has only grown since. So, a lot of this stuff isn't really going to determine forward S&P 500 or technology sector results in the next 12 months. So I get that, these are things to be aware of. I don't think they're tools for decision making with your portfolio. Now, this is another example. This is what I call bad data on the surface and look for other confirming data. This is from Tom Lee, Fundstrat, and you may have heard him say over the past several weeks when he's looking at the month of December and the possible returns for the month of December. And what he's noted, you may have heard him on CNBC say, if you're up 10% or greater, going into December of an election year, the S&P 500 has never delivered a negative return in December of that election year. Never. So you have 100% probability of a positive return in the month of December. The only issue I take with this is when we talk about it's never delivered a negative return, because it's always been higher if you had a 10% gain in an election year going into December, is what I circled. There's only 2 previous occurrences. Our sample size is 2. Now, I'm not one for, assuaging the probabilities based on sample size because we can't control these things, right? Look, the market does what it does. This is not a laboratory where we're testing monkeys or animals for, to create a vaccine, and we can control, the numbers of samples. We can't do that in the market. It just is what it is. The occurrences happen when they happen. It's not a controlled study. So sample size nonsense that people always look to is not always a valid detraction from the quantitative study. Having said that, when I do have this kind of limited samples, I find it applicable to use other data. And he has the other data here. And it's very similar to what we saw with Ryan Dietrich's study. If you're up in the first half of the year, greater than 10%, the month of December is up 83% of the time. That's still a very high probability that you're going to get a positive return in the S&P 500 in the month of December. So again, on the surface, this is not what I would make decisions based on two occurrences, this being the third occurrence in history. But there are other data points that suggest very much the same thing, a positive return in the month of December. So, quantitative analysis is not always as easy as we liked it to be. We need to kind of look at the individual rows, what the individual columns represent, sometimes look at the dates of occurrences to better understand what I'm really going to be leaning into so far as the probabilities going forward. This is the kind of data we like. Okay, now back in July, and when we started to correct, we had a decent correction, not a full 10% correction, but a better than 5% pullback in the month of July before really accelerating and finishing positive for the month. But while everybody was all nervous and what have you, I said, hey, the odds favor the bulls, folks. So just sit still, look pretty while the bears lay their own trap. Again, this is a post that I put on X. I'm the bears' best friend. I give them fair warning, Brad. I give the bears fair warning. How can they dislike me? I told them, And certainly a lot of bears did set their own trap. Now, the reason why I was so confident is always about the data. It's always about the data. There has only been one all-time high set in July since 1980. 43 plus years. And of all those 43 years, when the market made a high in July, it always made highs thereafter, except for one time. So the probability that the high for the year was set in July was very, very unlikely. So that's one data point. Never has the S&P 500 made 38 all-time highs in a year and not made at least one more. It's another factual data point suggesting there's a high probability that we're going to make more highs in 2024. We had a Whaley breath thrust trigger on July 16th. It has a 93% positivity rate 6 months forward, telling us that there's a 93% chance or 93% probability that by December 16th, i.e. 6 months forward, we would be higher than the signal date and price, which would be another all-time high. When we are up between 15 and 20% in the first 130 trading days, there's a 95% positivity rate from day 131 to year end, with an average 8% return over that time period. So again, month of July, we pulled back 5-6%. People were getting really nervous. Sit still, look pretty, buy the dip because the data says so. Fast forward, here we are in December. We're a lot higher than where we were in July 16th or July 20 when I posted this. That's the data we like. It's not right sizing. It's not right fitting. It's hard data. Now, this just happened a week or so ago, 2 weeks ago, I think. This is from Quantifiable Edges, Rob Hanna. The NYSE up issues, number of stocks moving higher on a percentage basis was greater than 70% for 3 consecutive trading days. Rob calls that the 70 breath thrust. The forward probability for the S&P 500 75, 80, 85, 90 days forward, they're pretty darn strong. All of them are 87, 86, 87% or better. So based on this breath thrust data from Rob Hanna of Quantifiable Edges, This fired toward the end of November, I believe, and into probably the early trading day of December. So if we're looking out some 75 trading days, market has a really high probability of being higher than where it was on the signal date. Again, hard data. It's telling you about fund flows. Fund flows produce this breadth thrust. Fund flows are very repetitive when we think about the future returns of the S&P 500. And here's another one. I think this is our last two studies of this video. And it looks at the VIX. The VIX it got above 20 briefly. It got above 20 going into the election. It got above 20. And then it has come, after the election, has come back down to below 14. Now I'm looking at the final column here, which is the 12 months later for the S&P 500 performance. 12 months later, only one loss, and that was back in 2015. Only one loss. So you have a 96% probability that the S&P 500 is going to be higher than the signal date, which was on 11/29, November 29. So we would go to the S&P 500. Let's go see. You might want to mark your calendars, folks. Mark your calendars, November 29th. Oh, 1 year, sorry. So we get the days. There we go. 60/32, folks. So November 29th of 2025, we should be higher than 60/32 based again on this positivity rate. Now, you can use, what's the median return of the S&P 500? 14%. Do you think we're going to have a double-digit return next year, folks? This suggests, now this is just the median return. There's returns that are as low as 6%, 4%, 5%, 6%. It's up to you whether you want to use the medians as modeling your expectations going forward. I generally don't, but it's a good idea to know what you might anticipate as a baseline. This just happened in the month of November also. Small cap Russell ETF gained 10%. 1 month rate of change, 10%. It was actually 10.8% as shown in the study here. 6 months forward, only 2 losses. Only twice. 20 occurrences, good sample. Okay, we got a good sample here. 20 occurrences, only 2 losses. A few more losses when you look out 12 months, but only 2 going out 6 months. So if you think that the strength in small caps to end 2024 won't persist into early 2025, this data suggests the fund flows have a tailwind. They have a tailwind at least through the first 6 months or the next 6 months. All right, with that, that's all I've got, Brad. What else you got for us, sir? What are you thinking about 2025? What would be your, I'm not going to ask you for a price target on the S&P 500, but feel free to divulge if you are compelled.
Okay.
How do you think things are going to play out? What are some of the risks, and how do you think it plays out?
Okay, we've got Trump 2.0. So partisanship aside, you've got those concerns about tariffs. His ideas about he's going to deport all the illegal immigrants and all this kind of stuff. And what I think, and Seth, I made some money off his first term because sooner or later he's going to say something. It's going to rattle people. And I remember, I can't remember which year it was, but when he started talking trade war with Mexico and the market started selling off, I thought, oh yeah, bye, because we're not going to do that,
Right.
And I'm hoping the tariff thing will be the same thing, because you don't have to be a partisan to know that heavy tariffs globally is a bad idea. that's just something that won't
The
work. And I'm
bark, the
hoping,
bark, the
yeah,
bark in Trump 1.0, the bark was bigger than the bite.
yeah, it was. It really was. And I think that's probably what you're going to see here. But, as investors, we need to pay attention to politically what's going on, because
Yeah,
if he barks, you're probably going to get an opportunity.
yeah.
And I think you're going to get several little loud barks during the year that you can buy into. So that's how I'm going to play it. I
How
know,
do you plan for that? Are you planning that with cash, or what does that look like as
yeah,
far as your okay?
I noticed just in our chat that you're kind of doing what I'm doing. I'm trying to probably get pretty close to 50% cash around the end of the year. I'm around 45 now, and I'm not just locked into that number. I got to tell you, if I got an opportunity, say in Amazon at 209 or something like that, I'm not
Yeah,
buying.
I
But
agree.
so I'm going to be smart with blue chip stocks. If something takes a dip for no good reason, I'm just going to buy it. But 45-50% is kind of where I'd like to be, and then I'll just step into the waters a little bit at a time. I always do it in January. Just kind of see how things are playing out. What's going on with Trump, what's going on with Congress. Uh, what are the markets doing? What are earnings looking like? And
Yeah,
just a
earnings.
little
Yeah,
bit.
I'll definitely. I mean, the earnings expectations are again strong for the coming year, and they should ratchet down. It's important that investors and traders understand that the estimates that we see before us today are not going to be the estimates that we have as we get into the earnings season for Q4, February of next year, right? Because I mean, they
Right.
always lower the estimates to a certain degree so that companies essentially have a lower bar to jump over. I'll kind of give my thoughts, and this is just a rudimentary, as most of our work has already been incorporated into our year-end and year ahead outlook report, which is going to be updated consistently through the end of this year. Why? Because we need to see how the year completes, and how price action is trending to get a better model or better improved outlook for 2025. So our Finom group members should be on the lookout for revisions. With that being said, I think about tariffs, I think about inflation, the Fed, and earnings, and I kind of put that all into a stew pot, if you will. And I recognize, what does the market look for? The market takes its cues from inflation. Primarily, that's it. That's the number one priority for markets. Why? Because inflation is going to influence the Fed. As long as we have a friendly Federal Reserve or monetary policy, the market should be okay, possibly delivering a positive return. It may be more volatile because of fiscal policy and just a more a megaphoning president and what have you that use different tactics. So we may get more volatility, we may get more pullbacks. We definitely saw that in Trump 1.0. But as long as it doesn't pull the Fed into an adversarial role, creating headwinds for markets, then the market should be fine. It's generally only when inflation pulls the Fed into the picture where it has to be adversarial that the market has
Mhm.
delivered negative consequences. And so, earnings can do whatever. I mean, earnings generally are going to do whatever. That's not the market for any 12-month calendar year. The market does not take its cues primarily from earnings. Do we want the earnings to be there and trending in the right? Yes, because it's just it's a ballast. It's a ballast for the market. But the market is not going to solely rely on earnings results. Its primary or primer is inflation, because inflation is one of the two dual mandates of the Fed. And either we're going to have a friendly Fed or we're not. Now, I'm of the opinion the Fed is going to pause in the Q1 period after this last rate hike, possibly here in December. A pause is fine. Again, as long as they're not hiking, they can pause for all of next year. They will still be a friend to the markets. A pause is fine. The only scenario or posture of the Fed that is adversarial is when they're tightening policy. Markets don't like that. So that's kind of my broad framework, of course, for the S&P 500. That doesn't include obviously technicals or quant studies and breadth, which would only add to what we're looking for through this year's end. So with that, I hope everybody enjoyed our state of the market. We'll have one more of these before the end of the year. So stay tuned, take care, be well, trade smartly, everybody.